On the Tape is presented by CME Group, where risk meets opportunity. iConnections, reimagining how the investment industry connects. And SoFi, get your money right all in one app.
A warm welcome to the On the Tape podcast. Guy Adami, joined by, get ready for this one, Elizabeth Young Thomas, EYT. So I'm going to have obviously some issues going forward, but I will figure it out. Now, before we even start, Saturday, my wife and I were at an amazing event. We got there late. That's on me. But the event was spectacular, and it was your wedding. And I will tell you once again, heartfelt congratulations, Elizabeth. It was a beautiful night. The only thing more beautiful than the evening was you.
Aw, thank you very much. Yeah, the weather gods shined down on us. It was a perfect evening. Anybody listening to this will understand the temperature was great. The women weren't cold. The men weren't hot. Everything worked out exactly as it should. The pictures are amazing, and we couldn't have asked for more. So thank you for being there.
It was wonderful. And when you say the men were not hot, you're speaking in terms of temperature.
Heat hot.
Right.
Heat
because
hot.
there were some good-looking men there, just saying.
They were
obviously your betrothed leading the way.
Yes.
With that said, here you are with us on this Monday, and you're going on your honeymoon next week. So thanks for doing this.
That's
But
right.
last week was an interesting week for a myriad of different reasons. And for me, the one that stands out is, once again, the volatility in the bond market. We saw yields cascade lower earlier in the week, only then to see a pretty significant rise late in the week. And, that's the trajectory that I think yields will continue to go on. However, it has not been a straight line. But that move back up in 10-year yields, with now the 2-year yield pushing towards, again, 4.9%, probably back on its way to 5%, is interesting, especially in the context of what we have this week, which we'll talk about in a second. So just thoughts upon that look back to last week.
Well, a lot of it had to do with the jobs data. And the jobs data, I would say that was one of the more confusing reports
Agreed.
that we've gotten. So we had an unemployment rate that rose. We finally got the 4 handle. The unemployment rate rose, but what the market reacted to was more so the number of jobs added. And they took that as a hot report, strong economy, labor market's still healthy. Here's the thing, and this is what happens when you dig deeper into the data, look under the hood. For a while, what was happening was the unemployment rate would tick up here and there, maybe a 0.1%, but it was happening because, or it was being explained away because the labor force participation rate was also going up. So the math of that told us that, well, people were joining the workforce, coming back into the workforce or joining it anew. That's why the unemployment rate went up, because they weren't getting jobs as quickly as they were joining, which would have been good news. We had more workers available for all the jobs that were available. That's a positive thing. So it was an unemployment rate rising that nobody was really concerned with. What happened this time is the unemployment rate rose, but the labor force participation rate fell. So that means that the people that became unemployed were ones that got laid off or lost their jobs, not ones that came into the labor force anew. So although none of these are concerning numbers at this point, there's nothing to be worried about as the data was reported, but it did change. The dynamics of it changed a little bit, and that's something that you want to watch going forward.
Agreed. And again, what's fascinating, depending on what side of the spectrum you're on, and look, we all have our dogma without question. I have mine, but you try to be sort of unbiased as you can when you look at this. And when you look at the headline number, okay, to your point, it wasn't a huge deal necessarily, although I do think that trajectory higher in the unemployment rate will continue. And at a certain point, the market's going to take notice. However, when you sort of dig below the surface, you see some disappointing trends, which have been in place, but are starting to sort of accelerate, I would think. And maybe in small part, that's why the market saw that turn, and maybe that's why the bond. But also, what you see is, there's still wage pressures going on, which, again, I think speaks to sort of the dilemma that the Fed is faced with, which, again, they're going to speak on Wednesday in earnest. And I'm hard pressed. And I saw Mohammed Al-Arian last week, I think it was on Bloomberg, but stating, if the Fed is true to their word, there's no conceivable way, they could start to be talking about rate cuts early in terms of, the rest of this summer into the fall. And I sort of agree with them. I think you do as well.
Yeah, I absolutely do. And one of those things that you see as a concerning trend in the labor data is that full-time jobs continue to come down. So we're losing full-time jobs, we're gaining part-time jobs, but everybody's heard those anecdotal stories about somebody who's got 2 part-time jobs, adding a third part-time job just to make it all come together and make ends meet. That is concerning because if you've got a bunch of people kind of patching together part-time work and we're losing full-time workers, that's something that the economy over time will see weakness in. And I do agree. So the Fed's projection of what the unemployment rate will be at the end of this year, as of right now, is 4.1%. Now we get an update on their projections this week, but it's 4.1%. I wrote in my outlook, which will drop later this week. I wrote in my outlook, I think it's going to be higher than that. I think the unemployment rate is going to be above 4.1%. If I had to put a number on it, which I don't like doing, somewhere between 4 and 4.5. Now, again, not a concerning number. That would be okay. I just don't think the market is going to be okay with it if we start going up steadily above 4%. So we have to wait and see what happens there and wait and see what happens with the Fed. But to your point, this week, this is a huge week. I said this last week. I've said it, I think, for a couple of weeks. This is a really big week, not just for economic data, but it's because it's all piled on top of each other. So we've got CPI coming on Wednesday, which obviously we hang on every single data point that's in that report. And we've got the Fed coming out on Wednesday with a new summary of economic projections. And we've got them making a statement. Nobody expects them to change rates this week. I don't think they will, but we have seen the expectations for a July cut move around quite a bit. So I think we'll get some indication from Powell on whether or not he still expects higher for longer. We're going to, obviously hang on his every word and see how he's feeling and how the Fed is feeling about how the data has progressed since the last meeting.
I agree with you in terms of the importance. And I think the parsing of the words is important. Well, I mean, as magnified as it is historically, more so now, given some of the cross currents and given the fact that we're, effectively halfway through the year. And I do think market participants are really trying. Again, I say be careful what you wish for. And, I still think there are a lot of people, for whatever reason, that are wishing for those rate cuts, a lot of them probably in very economically sensitive businesses, and it's somewhat self-serving. But I'm not certain that that's really the panacea for what I still think, not an ailing market by any stretch of imagination, but an ailing economy. And I'll say this, typically is something we don't talk about, but tomorrow you have this NFIB Small Business Optimism Index for May. And it's typically something we don't talk about. And the only reason I bring it up now is I think it's actually sort of important. And you've seen some, again, the cross currents in terms of optimism, University of Michigan survey, all these different things. We've had some really good surveys. We've had some really poor surveys. This one, to me, though, I think there's going to be, I don't know if it's necessarily going to be a market moving importance, but it's something I think people should start to focus on.
I agree. And it is something that I watch, not only because I'm obsessed with small caps, but I do watch it because I see it as a leading indicator. What we've heard over the last few weeks is that the soft data is telling a different story than the hard data. So these surveys, including consumer confidence, consumer sentiment, that's what would be considered soft data because they really are just surveys going out and asking business owners or asking consumers how they feel about certain aspects of the economy. But then when you put it up next to the hard data, so GDP reports, CPI reports, retail sales, the stuff that is measured and countable, the hard data keeps telling a pretty solid story about the economy. So there's been this contradiction going on. The survey that we're talking about for tomorrow, the NFIB, it would be considered soft data, but that soft data is how people are feeling, and they're going to change their behavior based on how they feel. Consumers are the same. So if they feel concerned about the labor market or they feel like inflation is only going to continue going up or stay elevated, they're going to change their purchasing behavior. Likewise, small businesses will change or at least pause either their spending plans or their hiring plans. And that matters because when we're looking at the rest of 2024, the labor market matters probably more so than it did in the latter half of 2023. So if small businesses are going to pull back on hiring or pause on hiring, remember, they make up 60 to 70% of the workforce. And that's going to matter. That will eventually bleed through into the numbers. So that survey is a leading indicator.
100%. And, I'll throw on top of that, by the way, the fact that the small and regional banks, depending on how you measure them, I look at the KRE. I've seen a number of different articles talking about some of the underlying weakness, the unrealized losses on the balance sheets of a lot of these banks. That has not gone away. That's not been abated. Now, look, the Fed's done what they've needed to do to sort of assuage some of the concerns, but it hasn't gone away. So when you think about what you just talked about, and you think about the lifeblood of these companies is basically small and regional banks, and you put that in a pot and mix it together, again, it's just me. I don't think it augurs particularly well, which is another reason I think that survey tomorrow is really interesting. And at the end of the week, you have University of Michigan on Friday. And it'll be interesting to see if there's some sort of, again, if there's some juxtaposition in terms of one says one thing and then the University of Michigan says the opposite. So, we'll see. And that's why I think this week is important. Let's get a little granular here. And there was a Wall Street Journal article out, and I'm going to sort of go through the bullet points, and I'm curious as to your thoughts. So the first bullet point, and by the way, I think the title of this was Beneath the Calm Market, Stocks Are Going Haywire, which is true. It's something we talk about all the time. And the article says only once in the past 25 years have individual stocks swung so much while the overall market has stayed placid. And that's true. By the way, individual stocks to the upside and the downside. Now, with that said, what I've noticed is the dramatic moves have been to the downside, and we can rattle off a bunch of names, but there obviously have been some pretty impressive moves to the upside as well. So thoughts on that? I have my thoughts. I'm curious as to yours.
Yeah, well, it's actually similar to what we talked about last week on market calls. So you've got this concentration in the index that's driving everything. And we've seen this theme throughout this entire cycle where there are periods where the market broadens out and we can see the other sectors that are taking part. We can see smaller cap names taking part, or indicators like watching the equal weight S&P versus the market cap weight S&P. What's happening over the last couple of weeks is that the market cap weight S&P has again taken over, the equal weight has trailed, and you've got a broad market that's dominated by the performance in those top names. So it looks on the surface at broad brush that everything is okay, but really the participation has come down quite a bit under the surface. And those swings, I mean, not even just in stocks, the swings in yields and treasury yields, in and of themselves, not an indication that something is terribly wrong. However, you start to wonder about how the market is functioning and if it's functioning properly, especially if you start to hit periods of volatility. You want the liquidity in the market to be functioning properly, and you don't want volatility like that during times that are supposed to be relatively benign, because that's an indication, to me at least, that investors are not sure that they want to, number one, stay in risk assets, but they're also not sure that they want to stay in treasury assets. And there's all of this indecision and back and forth, which can create more volatility, especially during a seasonal period. Now that we're middle of June-ish, a seasonal period where you typically have lower trading volumes because people are enjoying summer, they're on vacation. Lower trading volumes raise the risk of big swings in the market if news comes across the wire.
And, just to dovetail that, I agree. And I've talked about this and I know you agree, but, the advent and the rise of passive investing, I mean, to a large extent, I think that's why you're starting, you'll see moves in the individual names for the correct reasons I would assess or I would basically oppose. But with that said, the broader market doesn't seem to move. And that's because of the money flows, I think. So, you'll see that sort of, one-off here and there, and it's been more than one-off in terms of individual stocks. But with passive investing, the market seems to continue its course. And, one of the things that this also said, despite the calm appearance of the S&P 500, individual stocks have been experiencing significant volatility, many of them seeing 10% moves in any given day, which is absolutely true. And I don't think that's particularly healthy, but that's me. Then it went on to say, and this is something we talk about as well, traders in the options market are betting this is going to continue. Prices indicate the biggest swings in stocks for the last 10 years relative to the prevailing calm for the S&P 500. So again, individual names, maybe people are taking advantage, maybe not. But in terms of the broader market, they're absolutely taking advantage of it by continuing to sell volatility, which is every time you see the VIX or whatever measure you want to talk about move to the upside, it is immediately thwarted and sold back down, because I think market participants realize that, whatever broader market move is going to be short-lived. So, I'm not asking you to comment on the VIX, but the mindset around just the complacency and the boldness with which people sell volatility.
I think the last part of your statement was the most important. It's this mindset that it's only going to be short-lived, even if there is volatility. And part of that is that there is still an expectation, and I don't even think it's that misguided. There's still an expectation that if something does go terribly haywire, the Fed is going to come in and provide liquidity. Remember what happened, and I don't think we're headed for a situation like this right now, but remember what happened when oil suddenly traded below zero. I think it got down to like negative $40 a barrel. Clearly, that was not a well-functioning capital market at the time. The Fed came in and the bond market went haywire too. We had investment grade fixed income that wasn't trading properly. We had treasuries that weren't trading. There was way too much volatility. I won't be surprised if later this year, we at least start hearing from the Fed something about, we're a little bit concerned with what we've seen in trading activity or in the big swings. It's not making us comfortable because we focus so much on their mandate, which we should, about inflation and about labor. But remember, they also have what's called the Financial Stability Report, and they do monitor that. And one of the things that goes into their gauge of financial stability is the proper functioning of capital markets. So if this volatility, if these swings keep up, I think we'll start to hear from them about it. I don't know that they'll do anything about it yet this year, unless something goes absolutely terribly wrong. But we may start to hear from them about it again.
It's interesting. Yes, I agree with that. And what's interesting is, we always, or I shouldn't say we, I think in large part, I always look for the cracks in the surface here, but sometimes you have to look elsewhere to see those cracks, and then understanding that at a certain point, they're going to make their way here. And I remember you saying this to me and Dan a couple of years ago, that you said there's a real good chance that the Fed moves the goalposts in the form of 2% being their goal for inflation. And you thought that initially, that might be championed by the market until people realize that, it's them effectively waving the white flag. And, that stuck with me. And I think we may have seen that. This is just my opinion. I'm curious as to yours with the ECB last week, which lowered rates in a move that was highly anticipated. I don't want to pretend it was not. However, they did raise their inflation outlook. And I saw that. I'm like, holy shit, there's the white flag. And that's something that Liz talked about a while ago. You obviously in terms of our Fed, but it's happening now elsewhere.
Yeah. And to be absolutely clear, I don't think they're going to change the target explicitly. I don't think they're going to come out and say, you know what, 2% is yesterday's target. We're going to make it 2.4 and be comfortable with that. But I do think they're going to have to get comfortable with it higher than 2%. So the question really is, are they going to start moving or talk about moving before we get to 2%? I think the answer to that is yes. And my take on that has been they might have to because it's stuck. It's stuck by shelter. It's stuck by services. We got some really strong services data last week. So I don't think that services inflation component is coming down anytime soon. So they may have to just sort of say, you know what, 2.6 is good enough or 2.4 is good enough and start talking about cutting. The issue, I think, is that what it looks like to me, at least, is that, you know what, we as the Fed no longer have the tools necessary to control inflation. We've we've entirely lost control, but we don't have the tools in our tool belt to get it to where we want it to be, which I do not think is a good thing. And the market is sort of left to its own devices. Inflation is left to its own devices. And we may say that that's actually a good thing. You've got more of a free market moving system, or you've got inflation that'll come back into balance or not on its own devices. But if it goes back up again, if they don't have the tools and it goes back up again, that's when you start to get really nervous, because then what do we do? Then it's almost you have to let there be a big contraction in the economy to take care of it if we can't take care of it in a more benign way.
The other thing that I think, again, one of the narratives late last year into this year was there was going to be a broadening out of the market. And a lot of people thought they're starting to see that broadening out, which I would push back on, but the data suggests exactly the opposite, that in fact, the broadening out has not been taking place. The bigger names continue to dominate in a more significant way than they have before, not only in the form of performance, but in the form of their overall contributions to earnings and earnings growth and the percentage of basically the moves in the broader market. So why do you think, I'm curious again, that seems to have been dropped completely. The fact that it's just these 6, 7, 8 names once again are dominating the landscape. Again, not only in terms of the importance for the market, but the importance for earnings and earnings growth.
Because the results have still come through pretty positively. I mean, NVIDIA came out with positive results, and we still have this enthusiasm about AI. And I think there continues to be a belief, and maybe one that's even growing, that AI will change where we are in the business cycle. It will increase productivity to a point where some of that other stuff just doesn't matter. I think it all matters. And it doesn't mean that it's going wrong right now, but we are so dependent on AI and AI adjacent themes right now to drive all of this forward that as long as we continue to get good data from the companies that are the poster children for AI, I think it can carry on. And here we are again. This is sort of old news being driven by these top heavy large cap names. But I say this so much and I stand by it. Large cap heavy markets are late cycle behavior.
Yes, 100%.
So it's like it's still there. You're seeing all of the markers, all of the symptoms of late cycle. And the other thing I would point out, the market typically bottoms after the Fed starts cutting rates. Now, there's obvious reasons for that. They're usually cutting in response to a weakness in the economy. The market bottoms after that. The market does not bottom before the Fed starts cutting rates. So we've heard a lot of comparisons between now and the mid 90s. Well, maybe they can pull it off again like they did then. Here's the difference. In the mid 90s, I just looked this up. This is also in my mid-year outlook. The unemployment rate when the Fed started cutting rates was 5.6% and falling. Okay. The labor force participation rate was rising. So remember what we talked about in the beginning of this podcast. That was a different economic environment. And it was almost more supported that they needed to stimulate. They had an unemployment rate that was uncomfortably high. They wanted people to join the labor force. And that is exactly what happened. It was at 5.6% and falling, labor force going up. They started to cut. It was stimulative. The economy was strengthening. Okay. We are in a period right now where we actually are hoping for the economy to cool so that inflation gets taken care of. And we're in a period where the unemployment rate was low and now it is rising. The labor force participation rate fell this last time. So different economic environment. And if the Fed starts cutting rates now, it's more likely to be in response to weakening economic data, not into a period where the economy is strengthening.
With you. And I think, again, it's seemingly lost on I take a lot from what you said, but the fact that you continue to talk about late cycle behavior and just basically characteristics that are emblematic of exactly that, where you have so many other people talking about early to mid cycle. I just don't understand what they see because, again, if you're just trying to look at this without, with no dogma whatsoever and just look at the data, I mean, it suggests exactly what you're talking about. Yet there's still people hopeful out there that we have a lot of runway left. I don't see it either. But I think their argument is again being backstopped by a market that seemingly is able to cleanse all the sort of the dirt away from what appears to be a pretty, at best, nebulous argument. Anyway, that's just me. Let's talk about Apple real quick, and I don't need your because I know you're not going to talk about individual stocks, so I'm not asking you to do that. But I'll just again throw this out. In December of last year, I think Apple made an all-time high of, I want to say, 199 and change. And then by the late, April-ish, you had a stock trading down to 165. Now, I only bring that up because it was, again, on the backdrop of a market that continued to grind higher. And if you had told me in January that this is what's going to happen in terms of Apple, and then said, okay, Guy, what's going to happen to the broader market? I would have said we're easily in the low 4,000s in terms of the S&P, given that weakness in Apple. Obviously, that didn't happen. Subsequently, Apple has gone from 165, as I mentioned. We're right back up to those prior all-time highs. Okay, Worldwide Development Conference this week. And I'll say this is from Dan Ives, which I think is interesting. The AI strategy is the missing piece in the growth puzzle for Apple, and this event needs to be a showstopper and not a shrug the shoulders event. A lot of people are making comments about the importance of this and how they're going to address their AI initiatives and their basically strategy moving forward. So I guess my question to you is Apple, has it lost its importance in terms of a barometer for the broader market? Because clearly, as I mentioned, that move from December into April suggests exactly that.
No, I don't think it's lost its significance. But if we're talking about it relative to NVIDIA, it's not as significant. NVIDIA has now become the Apple of what we used to say a few years ago, where it's like, can the market go up without Apple? Can the market stay afloat without Apple? Now that we just replace that name with NVIDIA. However, I think as news cycles happen, Apple obviously has not driven the broader market. I think that's still the case until and unless they have a big move. So there are really high expectations, as far as I understand it, for this conference. And if they come out with something earth-shattering, I think there is probably a big move in Apple, and then that will matter for the broader market. If they don't, if it's a shrug your shoulders event, maybe they get sort of punished for it. I don't know what's going to happen in the stock, but I do still think it matters. And I think it will matter even more as the year goes on, because you can't just have one company driving everything for so long. And at some point, NVIDIA will not, grow earnings at double and triple digits. It just can't continue at that trajectory. So the rotation story, or the broadening out story, especially in AI, I think we'll need to start to include other names. And we'll see. I mean, I've been surprised by what this market does almost every week. So I think that this is one of the most important weeks of the year, not only because of Apple, not only because of economic events, not only because of the Fed, but because we're at this inflection point in sentiment where I think people are a little fragile, but they're still so enthusiastic that this one theme, this one thing can fix it all, can create productivity that completely bulldozes any concerns that we may have. And I think we're going to look back on this point, or at least this month, and say things changed in June.
No, listen, I'm with you. I think there is, it's interesting. You would look at this week. If you had looked at this week a few months ago and said, okay, it's going to be one of those early summer ho-hum weeks, you could have said, you know what, that makes sense. But then you think about what's happened since, and then now the importance of everything we're going to see and hear this week, I think it takes on an entirely new focus in terms of what people should be looking at. So I'm in agreement. Before we get out of here, something interesting happened late last week. You saw a dramatic move lower in gold, and I think it was on the back of the fact that it was announced that the Chinese did not buy gold in the month of May for the first time in many, many, many months. And the market took that as maybe a sign that they were done, and you saw a subsequent drop. I'm not convinced that's in fact the case in terms of them being done, but the market seemed to take that way, which, again, I think should come for a lot of people. I think that's sort of a welcome sigh of relief that gold is not continuing its meteoric rise. However, I still think that's relatively short-lived. So am I right to be looking at the gold market, do you think?
Absolutely. I think it's all in line with the fact that risk appetite has risen again over the last couple of weeks. On the heels of NVIDIA's report, we've seen a lot of enthusiasm in the market, a lot of buying appetite, and just risk across the globe has come down. And I shouldn't say that. Risk has not come down, but people's fear has come down. And some of the currency swings that we were seeing have quieted for the moment. I don't think they're over. I don't think this Japanese yen thing is over.
Great.
I don't think China's done buying gold. But for now, there's this sort of calm in the water, and that's fine. We've talked about gold a lot on these programs. I have been a pretty big owner of gold in a lot of different ways. I had GLD, I had PHYS, I have gold miners, I own gold in a mutual fund. So a couple weeks ago, I trimmed GLD partially because I just had so many gains in it. And it's one of those asset classes, and I would say this to our viewers, our listeners, our everybody, that if you look at an asset class or a stock, let's call it consumer staples as an asset class, and you've got gains, I was up like 20-something% in gold. If you've got gains in an asset class that wouldn't normally kick out gains like that, that's not a high beta asset, it's time to take some of those gains. So I trimmed it. I took the gains because it's not natural to have gains like that in a safe haven asset. So I do have a little less exposure to GLD now, but I'm still in gold in other places, and I'm going to remain that way because I don't think the rise is over.
I think this week, there are a lot of things that I'm obviously watching as we're sitting here this morning. I'm looking at a volatility. Again, I don't want to make a big deal out of this at all because it's still a VIX with a 13 handle, but a VIX sits up significantly on what, at least right now, is a pretty benign day in terms of the S&P, which is only down about 0.25%. So that's something to look at without question. And I'll throw this in the mix because this, Elizabeth, is something we haven't talked about for a while. And quite frankly, there's been no reason to talk about it. But for whatever reason, I'm starting to think the HYG, the sort of the high yield corporate bond ETF, is going to start to be a story again. Nobody's talking about it. Again, there's been no reason to talk about it, but this is something over the next few weeks that I think if it starts to trend lower the way I think it will, you want to watch. Sort of 76-ish is been a line in the sand. It's trading 76.75 now, but that's something I'm looking at too, Liz.
Yep. Well, spreads have been one of those things that have defied logic for a long part of this cycle. So we've got spreads that are tight, 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 both in investment grade and in high yield. And high yield bondholders have seen some really good performance. The credit market tends to, or at least the belief is, the credit market sees things before the equity market does. So if you start to see spreads widening out, particularly in high yield, it usually is some kind of indication that risk appetite is changing. And it's possible that that will happen. I do think that I think they could get tighter before they get wider again. I don't think we're at extremes in the equity market where people are going to get worried about it in the overbought category. But I do think that we will return to an environment where credit sniffs things out before equities do.
It's not often that beauty and intelligence go hand in hand, but Saturday night you illustrated that in fact they can, and they can do so in an extraordinary way. So EYT, great having you on, and thanks once again for your time. You're the absolute best.
Thank you. And I think we should have our viewers, our listeners, give us ideas. What should the new nickname be? You can use ET.
Yes.
You can use ET. You can use
I can
EYT.
do a lot with ET. I can do a lot with EYT.
You can use LT. Yeah. So send us some ideas. We'll pick one. And if we pick one of yours, I'm just like giving your stuff away right now. We're doing this live. You'll get a hoodie, you'll get a hat, you get a water bottle. We'll give you something.
I will sign a T-shirt. Not that I don't know if that's a good thing or a bad thing, but that's what I'll do.
There you go.
You're the best. Thanks, Elizabeth.
Thank you.